Today we are going to see a case study on business finance planning. How an young family planning for their future. The case study is an young married couple with the children planning for their future. They have two children. The person in the home is a David. He is working as a director of engineering. Tiffany stay at a home mom, a healthcare consultant. David was recently promoted earlier this year as a director of engineer for a very large oil and gas exploration firm in a Fragmenton. His salary is about 1,50,000 per year plus substantial bonus opportunities and equity share of the firm. Tiffany is a graduate on an East Coast liberal arts college specializing in healthcare issues. She has worked as a consultant and now she is in full time mode. They are devoted to their family and live well within their means. They have accumulated a substantial balance in their checking account. As the family, they enjoy campaigning in the mountains in the South Colorado. What is the importance of David and Tiffany? Their important concerns were providing for family. The actual issue is there is a concern if David prematurely dies, there would be a financial difficulties. Also, they don't have a will and there is no provision that the names as a guardian in the event they preside to their children. Next one is managing debt. With the interest rates very low, they should refinance it. And for educational planning, as a couple, they have both value a quality education not only for their children but also to continue to advance their careers. David is considering an MBA and Tiffany an advanced certification. Retirement planning. Need to review the contributions and the assets allocation. Contribution to the plan or nominal. Tax concern. This is a recent promotion early in the year. What is the tax impact on the David salary? They diagnose the financial things. Their total assets were 8 lakh ISD. Their income were in close cash flow was 3 lakhs. Less total liabilities 4 lakhs. So net worth will be a 4 lakhs. While like expenses if they reduce 1 lakh 50, the net cash flow will be 1 lakh 50. Their tax bracket was 30 percentage. Anticipated tax was $62,250. The step 3 will be the goals based recommendation. Establish a will or trust and the name a guardian for the children. Purchase the following term life insurance policies. David purchases a 500 lakh 10-year term life insurance and 1 crore 20-year term. Tiffany purchased a 2 lakh 50,000 10-year term life insurance and a 500 lakh 20-year term. Refinance mortgage to the lower payments and save interest and pay off out loan. Maximize 401k contribution and reallocate their retirement investments. Establish educational 529 plans for children. They reserve a fund for David's MBA, which means they have to keep money for their children's education as well as David is doing his MBA. It was his passion, so he reserves some funds for the education also. And moreover, provide tax clarity to prepare David and Tiffany for their higher tax situation. These are the goals-based recommendation given in these cases. The implementation and execution process in these recommendations were set up an appointment with attorney to prepare an estate plans including preparing their documents. So first they have to set an appointment with an attorney. In our areas we used to call as a chartered accountant to prepare an estate plans and include their preparing documents also. Then they have to meet with the independent life insurance agent to compare and select which term life insurance policy would be suitable for both of them with their children also. Then they have to meet the mortgage lender to refinance. Auto loan finance was to be paid off because every time the auto loan was going means they cannot able to calculate what the actual liquidity of cash was in their account. To meet the human resource respectiveness, it to increases contribution and reallocate retirement investment. Although they have to keep some amount for their retirement policies also. And moreover, they have to meet with an accountant to determine and prepare for a higher income taxes and affirm tax saving practices. They also to check whether how to save their taxes and how the higher income taxes can be reduced. And moreover, they have to meet an investment advisor to fund for the 529 plans and to begin an investment saving program. With the help of the advisors, they have to invest their savings. So that would be very useful for their future and also for their kids. Their final results were funding retirement product produced a tax deferred savings $4,644 annually. The projected retirement and investment savings is estimated to have a balance of $7,050 in 10 years and well over 1,500,000 crores in 20 years. Based on that number, it was determined that effective use of term life insurance will provide the protection gap until those balances are reached. This is how a young couple with their two kids plan for their future. Thank you.